Good morning, ladies and gentlemen. My name is André Stein. I'm one of the FAC3704 lecturers, and I will be presenting this discussion class with you today. Ladies and gentlemen, this is quite a strange way for me to present a class, and I'm sure for all of you as well. So let's try and spend this 2 hours wisely. What I want to tell you is to put the emphasis on the fact that doesn't matter if this was a live class or a class the way we do it now or presenting it now, that you need to know that 2 hours is not sufficient to cover this learning unit, which is learning unit 2. So you need to know that this is just to give you some kind of assistance. You will still have to go and spend the time as it was set out in learning unit, in tutorial letter 101, where we give you guidance on how long you should take with each learning unit. Okay, the lecturers on this module is Mr. Jacques van Staden, who presented the facet class last week, the first class. Then Ms. Tumi Kwaya, she will be presenting the next class, and then myself, André Stein. On the left-hand side, you will see the module email address, and this is also our preferred method of communication. We respond on this course within 24 hours. The email that you should use is fac3704@unisa.ac.za. Please keep in mind that we respond within 24 hours under normal circumstances. In other words, during the week. Over weekends, obviously, we are not working, so we will not responding to questions over the weekends. And then you need to take into account that normally the week or so before the exam, we do receive quite a lot of emails, and then it might take a little bit longer, but we still then try and answer within 1 day. So please make use of this communication, make use of us, that's why we are here. And yeah. The next one is if you have any administrative queries on this module, there's 2 options. First option is the FAC3704 bot. And Mr. Jacques van Staden explained about this in the first discussion class, so you can check out the bot on Telegram. And then the second option, if you do not come right with option 1, is our college information coordinator, which is Mr. Jabulani Chowki. There's the telephone number, there's the email address. Please make use of it when you have any administrative queries. Facet, with the invitation of this class on the announcement on MyUnisa, we ask you to complete the facet contracts or facet agreements. So please can you assist us by doing so? If you haven't done it yet, the contracts is attached on MyUnisa on the announcement in a Word document. Please complete those contracts and send it through to CAS student support at unisa.ac.za. Ladies and gentlemen, this is just really to help us. This program for the classes is sponsored by Facet, and we need to give something back to them, and they want the contracts. So you're not going to get penalized or more marks or less marks if you complete these contracts. It's just helping us to make sure we can present these classes and even more of these classes in future. Okay, a summary of what you've discussed, of what Mr. Jacques van Staden discussed in the first session was business combinations. Now this is like any other module that you're doing. It's like building a house. You need a good foundation if you want your house to be in a proper condition. It's the same with accounting. It's the same with all the modules that you'll be studying. If you've got a good foundation, everything else will just come easier. So please go and look at the first discussion class slide. It is on MyUnisa available, and make sure you work through that and through Learning Unit 1 to get a good foundation. Things that was covered in session 1 that I just want to touch on quickly is what is a group of companies. in a business combination, to understand what controls means, and that will be a subsidiary, how you account for non-controlling interest, how do you account for the consideration at acquisition, and then how do you account for goodwill or a gain on bargain purchase. So hopefully by now you've listened to the first discussion class, or if you've spent some time on this, you would at least know a little bit of this. If not, then now is the time to go back and work through these information, so that at least these things that I'm showing you now, that you know at least what it means and what the basics is around it. Okay, so learning unit 2, the consolidation after the date of acquisition. I said earlier we only have 2 hours to discuss this. Obviously, it's not possible to teach you everything in 2 hours. If it was as easy, then all of us would have passed this module within 2 weeks. So please listen carefully to this discussion class and then go and sit and spend the time. That's all how you're going to be able to pass this module. Okay, what is the objectives for me of this session? I want to explain to you the basic principles of the consolidation process. I want to give you examples, an exam technique or approach to a question. I want to show you how to get the easy marks in any question. I want to show you how to approach your studies all the way forward. And I'm going to say this maybe a few times. The important thing is you need to do questions and you need to mark them. And that's very important. And then I want to explain to you the type of questions that you can get in an examination. And then I want to emphasize how important it is to get a good year mark. And then for the repeat students, you need to do something different. Then one more thing, the content of this discussion class is not an indication of what's going to be in the exam. This is just to give you an idea what the module or the learning unit is about and to give you basic principles and guidance. All right, the points that I've just discussed now, points 1 to 7, I want to touch on points 4 to 7 quickly. How to approach your studies. Start early. I think it's already a good thing that you're attending this class or the session today, but that's not enough. So you need to start early and you need to work continuously throughout the semester. Then you need to know the basics. I'm going to explain a few basics today. That's just some of the principles in the learning unit. You need to know all the basics and all the principles of all learning units. What I want you then to do is, if you know your principles or basics, is to make a summary for yourself on 1 page for every learning unit. Then, most important, as I said in the previous slide, exercise by doing questions under exam condition. So there's questions in tutorial letter 102 and 103, and the easier questions is in tutorial letter 102, a bit more integrated questions in tutorial letter 103, and then all the exam papers that you will find on MyUnisa. So obviously start with the easy one first, tutorial letter 102, and then work your way up. If you get to the end where you get to the questions that's now on MyUnisa, you will see that solutions are not available. We're not allowed to hand them out. What we can do, and what we've done in the past for students, is you do the question, you send it to us to the course email address that I gave to you earlier, and we mark it for you, and we will give you guidance for where you went wrong and what you can do to improve. The next one, mark your questions. That's now the ones you've done in tutorial letter 102 and 103, and then learn from your mistakes. And I think Mr. van Staden said it last week in the first discussion as well. That's good to make mistakes. Make the mistakes now and learn from them. Then you make sure by that you do not repeat these mistakes or do not make these mistakes the first time during the exam. If you see what your mistakes are, add these new things to your 1 page per learning unit that you've made. Okay, so that will be additional notes that you add to your 1 page summaries. And then review those 1 page summaries regularly. If you make mistakes and you can see that your solution does not agree to our solution, in the 102 or 103, the important thing is you need to ask yourself why. What is it that I've missed? What is it that I've put extra on my solution that's not in the lecturer's solution, and other way around as well? What is on the lecturer's solution and not on mine? And then you need to ask why and what did I do wrong, and learn from there. Point number 5, the type of questions that we will give, that you will get in an exam. See what I've put in red there. If you know the basic principles and you've exercised that, then you can answer all types of questions. So what are the types of questions? Discussions. And you will see, if you look at questions in tutorial letter 103, you'll see there's not a lot of them there. So the discussion questions we only started to ask in the last few years, and I can almost guarantee you, you will get discussion questions in future. If you will just look at the previous semester's exam, there was discussions, financial statements, journals, multiple choice questions. So please take note of that. So you'll get discussions, as I said, calculations, journals, multiple choice questions, and then the financial statements and notes. One important thing that I want to put emphasis on is a lot of students, and especially the repeat students, thinks if they do the analysis of owner's equity, they think they have done a lot. Ladies and gentlemen, I want you to please listen carefully. An analysis is not part of the disclosure requirements. So except for if we ask you, please present to us the analysis or show us the analysis, and I can almost guarantee you we will never ask you to do so, that you please know that the analysis is just a calculation or a method that assists you to get to the answer or some of the answers that you will need to present in your financial statements. So it's the same with journals. If we don't specifically require from you to prepare journals to us, then you do not have to show it to us. Students doesn't know that as well, or they do not know that if we ask financial statements and they show the analysis and the amounts in the analysis is not transferred to the financial statements, it means they have not answered the question, and then we do not mark that analysis. So please take note of that. If we require financial statements and you use, for example, an analysis or journals to calculate your amounts, make sure you reference properly to your calculations from your financial statements. Then point number 6, the emphasis, how important it is to get a good year mark. There's a few things for me why this is important. First thing is you can only get a good year mark, obviously, if you work from the beginning and if you work continuously. So that's why a good year mark will be good, because then it means you start soon and you work throughout the period. It also helps to test your knowledge and your progress during the semester. And then lastly, which is also important, it gives you just that edge. If you do not have a good year mark, you, for example, need or may need 55 or 56 in the exam to pass the module. If you've got a good year mark of, say, 80 or 90, you will maybe just need 45 or 46 in the exam to pass this. Ladies and gentlemen, this should not be your aim. 45 or 46 in the exam should not be your aim. 50 or above should be your aim. I'm just saying a good year mark can help you if you maybe just miss out that 1 or 2 marks. Then repeat students, do something different. It's difficult to elaborate on this because I think each individual case needs to be looked at, because I don't know what you in person have done in the past, except for if you come to talk to me or we have a discussion about it. All I can say is I think you've done something wrong, especially if you've repeated this module now for a few times. So I think if you've studied in the past a few times, then I think the starting point for you as a repeat candidate should be to start immediately with old questions. So the next slide will be points number 1 to 3 on that objectives of this session. And there's just a few steps that I quickly want to discuss with you on how we will achieve those objectives or goals. Okay, as per Learning Unit 1A, you need to identify the entities in the group. In this discussion, we will only talk about a parent and a subsidiary. I think in the first session, Mr. Van Staden talked about associates and joint ventures and so on. That will be covered in the later learning units. So we will get to that in the later learning units. For now, we're only going to talk today about a group of companies which consist out of a parent and a subsidiary. And remember, a subsidiary, a bell needs to ring for you. There needs to be control. So either in the exam we will tell you there is control, or we will talk about a subsidiary, or we will give you information in the question so that you can see, okay, this is a subsidiary. Then you need to identify what is required. In other words, what is your goal? So A, you know it's a group. B, you read what is required. Now you know what your goal is. Then C, you check what was given in the question. If you know what was given, if you know what your goal is, you need to convert your goal or what was given with the principles in this module that you've learned to get to your goal. So in other words, you apply the principles to convert the information given into what is required or your goal. I hope that makes sense. So now we're going to say, how will we do this in the next few slides? Okay, so we give you information, as I said, for a parent and a subsidiary, and you have to do consolidated financial statements. Okay, so as I said, remember in this discussion, we will only talk about a parent and a subsidiary. That's all entities in this group for today. So first, what you will do is a parent and a subsidiary, you will have two companies. So you will combine the financial statements of the parent and the subsidiary on a line-by-line basis. Ladies and gentlemen, that's not difficult. I give you two sets of financial information of company A and company B, and your starting point is all the figures I gave you, you add together. Obviously now based on what I've asked you and what I've given you. The second step, you eliminate the carrying amount of the parent's investment in each subsidiary and the parent's portion of the equity in each subsidiary. Okay? So in this example, there's only going to be one parent and one subsidiary, so you'll be taking out the parent's investment in the subsidiary. And why is that? Because as a group, if company A has an investment in company B, for the group AB, can you see there is no investment? There's no investment in an external party, and that's why we eliminate it. But if you, for example, look at assets, and the one company A has assets of 100 Rand and company B of 20 Rand, can you see for us as a group, we've got assets of 120 Rand, and that's why we will add the 100 plus the 20 of the two entities. And then again, the parent's portion of the equity, we take that out as well. The third step will be to calculate and recognize goodwill or a gain on bargain purchase. Okay, and both these two, step 2 and step 3, is part of your first pro forma journal. Mr. Van Staden discussed the calculation and recognition of goodwill and a gain on bargain purchase in Learning Unit 1, but we will talk about it today as well. The fourth step is to calculate and recognize non-controlling interest and related transactions. Okay, so what is this non-controlling interest? It's just company A is the parent. Company A purchased, as an example, 80% of the shares of company B. And then if company A purchased 80% of the shares, someone owns the remaining 20 to get to 100%. And that 20 is the non-controlling interest. In other words, that's a few other small parties who's owning this 20% of shares. So why do we need to think about this NCI, non-controlling interest? Is if you look at step 1, if we add 100% of everything together, that means actually we've added a percentage of something that's not belonging to the company. And that's the non-controlling interest. And that's the reason why we calculate and recognize the non-controlling interest. And then the last step is to eliminate any intra-group entries. Intra-group entries can be just a loan between two parties, or as an example, if the one entity purchased inventory from the other entity. But we'll go into an example about that later as well. So that's the step. So ladies and gentlemen, if you, as I said at the beginning, start and you have a good foundation, in this module, in the exam, you will definitely get a question with a group of companies. There will most probably or definitely be a parent, and most probably, and I almost want to say definitely, a subsidiary as well. There could be 2 subsidiaries, 3 subsidiaries, and associates and so forth, but that we'll discuss later. For this session, start with the basics. Only a parent with a subsidiary. If you look at the steps, you must agree with me, if you just need to go and add everything together, there's nothing difficult here. And then it's just 2 things that you need to do after you've done this adding up of the different companies. Okay, this is just to show you how it all fits in together. You've got a subsidiary, you've got a parent, you add everything together, you do your adjustments. That's now the points 2, 3, and 4 from the previous slide. Okay, sorry, 2 to 5 from the previous slide. And then at the end, you get your consolidated financial statements. So let's look at an example. The following are the condensed statements of financial position of Johnny Limited and wholly owned subsidiary Bravo Limited, the acquisition date of the shares in Bravo Limited. Okay, if you just look at that, you can see there's going to be Johnny Limited owns 100% of the shares. So immediately if you see something like this, you need to think, okay, so there's no non-controlling interest. That's easy. And ladies and gentlemen, this is just as an example to explain you the basics. It will be, I can guarantee you will not get a wholly owned, or there's a big chance you will not get a wholly owned company in the exam. This is just to explain the basics. Then you look at the date. What is important, you see the date there, 31st December 2018. So now you know, okay, I've got a group of statements here, and my financial year end is 31st December. We gave you only assets here and equity. So you can look at this in your own time, then we read further. Assume the identifiable assets acquired and liabilities are shown at their acquisition date fair value as determined by IFRS 3. So now we know, okay, this is at fair value, so there's not going to be any changes or fair value adjustment that we need to make. Then Johnny Limited recognized the equity investment using the cost price method. Required. That's important. When you see the required, you need to focus. Prepare the consolidated statement of financial position of the Johnny Limited Group at 31st December 2018. So if we go back to our steps, what are we saying? We know what's required. What's required here is the statement of financial position. Okay. In this specific one, if you look at this information given, there's assets, which is property, plant and equipment, investment and trade receivables. And then there's equity, which is the share capital, retained earnings, and there's a liability as well, trade and other payables. Are we going to use those trade and other payables and so on? No, not in this one, because in this one, we only ask you the statement of financial position. Okay, what is the next step then? We're going to put the skeleton or the layout of what is required on paper. And then we're going to start, like we said earlier in step 1, we're going to add of the parent and the subsidiary, because it's wholly owned, this is a subsidiary. So Johnny the parent and Bravo the subsidiary, we're going to add 100% of all these information. So let's look at this. There's your skeleton. Assets, non-current assets, current assets, equity and liabilities as well, but that was not required. Sorry, let me just go one back here. Okay, in this question, I do apologize. I only said here prepare consolidated statement of financial position. This is now the full statement of financial position. I do apologize for this error. So there's the full statement of financial position, the skeleton. Then we look at the information. Can you see there, for example, at property, plant and equipment, 25,000 of Johnny and 12,000 of Bravo. That's just adding them together. Nothing strange here, nothing difficult, nothing new. Let's go further. The second step in our steps discussed earlier is to eliminate the carrying amount of the parent's investment in the subsidiary and the parent's portion of equity. So that was the share capital of Bravo, sorry, the share capital of Bravo, the retained earnings of Bravo, the investment in Bravo by Johnny, and the balancing figure is a gain on bargain purchase. Why is there no non-controlling interest? As I said earlier, because this is wholly owned. Okay, so Johnny purchased 100% of the shares in Bravo Limited. Is there anything difficult here? No. So this is just journals. Now we're going to take out this journals from the skeleton, because on the skeleton we've added 100% of both companies. We're going to come back to this gain on bargain purchase now. There you can see investment in Bravo Limited. We're at the 27,000 and now we've deducted. It's elimination. Okay, and in the exam, if you really know your principles, you do not even have to show us this investment in Bravo Limited. Okay, because the effect is zero. Let's go to the share capital. It was 50,000 of Johnny, 10,000 of Bravo Limited, and then less the 10,000, which is the elimination of the journal we've just done. Same with retained earnings. The only funny one here at retained earnings is the 3,000 Rand. So what is this 3,000 Rand? The 3,000 Rand is, if I go back one step, is your gain on bargain purchase. Okay? Why do we put it in retained earnings? Because Johnny purchased the shares in Bravo before year end. In other words, not in the current year. And then if it's a gain on bargain purchase in a prior year, that's a statement of profit or loss and other comprehensive income line item. In other words, it was in P&L in the past. Okay, and because it's not in the current year, it's affecting our retained earnings line item. Can you all see that? Ladies and gentlemen, and this is the consolidated statement of financial position of the Johnny Limited Group. If I can just go back one there. Originally, I thought I've read it incorrectly as only the asset section needs to be shown. I do apologize. The required specifically say the consolidated statement of financial position. In other words, that's the whole statement of financial position, the assets, the equity, and the liabilities. I do apologize for my mistake earlier. So, take 5 seconds and look at this. Only the red ones was because of the consolidation transactions. So the first step, the black ones, was just what was given to you. You just add them together, 100% of each of them. I know we're not covering associates and so on in this learning unit. I just want you to take note, make a note of it now. In future, in the learning units to come, this is not exactly the same what you need to do with associates and joint ventures. So only with subsidiaries, you will be adding 100% of the subsidiaries items to those of the parent. Make a note of it, it's important. Students make these mistakes in the exam and then they lose a lot of marks. Let's look at the second example. The following are the statement of financial position of Blue and its subsidiary Bull, the acquisition date of the shares in Bull Limited by Blue. Okay, again, we give you financial statements. Then we say in the paragraph, Blue elected to measure non-controlling interest at fair value at acquisition date. So you will see there's two types that you can give here. The entity can either measure at fair value or at the proportionate share of the non-controlling interest. Make sure that you know the difference between those two. So this one is the fair value, and you need to know that when it's at the fair value method, you need to know that the non-controlling interest can share or will share in the goodwill if there is any goodwill. Just make a note of that and make sure you go and read it and understand it. Okay, at that date, the directors of Blue Limited were of the opinion that the non-controlling interests were worth 3,000 more than their proportionate share of what the fair value of the identifiable asset and liabilities are of the acquiree. So not it was 3,000 Rand worth, 3,000 Rand more. So take that into account, or make a note of it, highlight it when you're sitting in the exam, so that you see, okay, but there's something different. Okay, we're going to use this one, the NCI, and calculate it at fair value. And then they say, okay, but this NCI is going to be 3,000 Rand worth more. The next line, assume the identifiable assets acquired and liabilities at the acquisition date are shown at their acquisition date fair values. Okay. Blue Limited recognized the equity in the separate records using the cost price method. Required. Prepare the consolidated statement of financial position of the Blue Limited Group at 31st December 2018. Okay, in the previous example, we told you it's wholly owned. What do we give you in this one? You need to just think or look carefully at the statement of financial position given, or at the information given, and quickly see if you can identify in this question if the parent bought 100% of the shares. Okay, so for those of you who haven't picked it up, if you look at investment in Bull Limited, in the statement of financial position given, you get assets, then property, plant and equipment. The next line item, investment in Bull Limited, 40,000 shares at cost. Okay, so 40,000 of what? Now we go and we look at the share capital 2 lines down, and we can see there Bull Limited owns 50,000 shares. Okay, so if Blue Limited bought 40,000 of the 50,000 shares, it's as easy as 40,000 divided by 50,000, and that will give you 80%. So now we can see, okay, there should be NCI here, and I see at the bottom in the additional information that NCI is carried at fair value, and we see there it says 3,000 Rand more, 3,000 Rand more. Okay, so let's go to the next slide. Again, we put the skeleton out. We know what was asked. We know it's the statement of financial position. And ladies and gentlemen, sometimes we give you a set of financial statements, and sometimes we'll give you a trial balance. Obviously, if we give you the set of financial statements, most of these items that you can see in front of you, the skeleton, at least they are there. But if we only give you the trial balance, this information is not there, and that's why you need to know this format or skeleton or layout out of your head. Okay. Remember, we first add the TBs or the information of the two companies if it's a parent and subsidiary together. Okay, can you see here all the black ones? This was given. Okay, the only red item that you can see here is the non-controlling interest. We know, I said to you earlier, it's 40,000 out of the 50,000 shares. So there's somewhere, that's 80%. So somewhere there's 20% non-controlling interest. And because we add in all the other line items 100%, we will have to put in this non-controlling interest portion. But we first have to go and calculate it. So what do we do next? We eliminate the carrying amount of the parent's investment in each subsidiary and the parent's portion of equity. So that's just the share capital of the subsidiary, the retained earnings at acquisition of the subsidiary. So let's just go back. Okay. There you can see retained earnings, the third line from the bottom in the table, and then in the column of Bull Limited, 8,000 Rand. Okay. So the share capital, the retained earnings, the revaluation surplus that was also given. Sometimes something like the revaluation surplus is not given in the financial statements of the trial balance, but then we will give you a paragraph or a sentence in the additional information of such information. And then you need to know, okay, if it is applicable on the subsidiary, you will have to take that information into account when you do this journal. All right, again, the investment in Bull Limited, 48,000. The non-controlling interest, can you see here, it's the 50,000, the 7,000 and the 8,000 above this first three line items. In other words, it's the equity of the subsidiary multiply by the 20% that these non-controlling interests, these other parties owns, and then plus the 3,000 Rand. If you remember in that one sentence, we said NCI is carried at fair value and the fair value is 3,000 Rand more. And that's why you've added the 3,000 Rand there. And then the balancing figure again on bargain purchase. I think Mr. van Staden explained to you the difference between the goodwill and a gain on bargain purchase. So if it's a credit, that's balancing here. It's a gain on bargain purchase. It's going in the year of acquisition to the statement of profit or loss and other comprehensive income. If your acquisition date was prior to the year we're reporting on, that will go into retained earnings. If it's a debit, goodwill, it's always in the balance sheet as a non-current asset. Are you happy? Now let's look at this. The black was the easy one. We added everything together. Now we eliminate the investment in the sub. We take the 48,000 out. As I said, you don't have to show this. Then we look at equity. Equity, the only thing that will be remaining here is the parents portion, the parent share capital. Okay. So to make it easier for you, if you do not understand, that's why we said you add everything together, 100%, and then do your journals and apply it here. But if you can see here, the share capital, what's remaining is only going to be that of the parent. So if you think about it, if you want to spare time in the examination and you understand this principle, you don't even have to show me that plus 50,000, less 50,000. The revaluation surplus, the same thing. Retained earnings, the same thing. Okay? So your equity items will at the end be that of the parent, the remaining ones. And then you can see here the only difference that will come in here to the parent is the gain on bargain purchase, the 1,000 Rand that we've just calculated. So that you will add because that is because of this group of entities. And then, as I said earlier, because we brought in everything at 100%, we need to show the non-controlling interest amount. So that's the 16,000 that we've just calculated in the previous slide. So there's your 16,000 non-controlling interest. There's your gain on bargain purchase, and that's where you put it into your statement of financial position. Okay, let's look at the next example, example 3. The following are extracts from the trial balances of Fred and Daphne Limited for the year ended 31st December 2015. I just want to stop there. If you just look at that and you compare it to the previous examples that we had. Okay, in the previous examples, we gave you a piece of a financial statement. Okay, in this one, we give you a trial balance. Same information given, but just in a different way. So I don't want you to be scared if you see it appearing in the exam in a different way. You can still see here what my property, plant and equipment amounts are. And at least in this one, we gave you the carrying amounts as an example. And that's the amounts that you will be disclosing in your financial statements. Okay. So if you look at this and you see the debits and the credits, and just before I even look at what is required in this one, just to give you an idea, if you scan through it, you need to be able to identify which of these line items belongs to the statement of financial position. As an example, property, plant and equipment, cash and cash equivalents, and which items belongs to the statement of profit or loss and other comprehensive income. As an example, cost of sales. On the credit side, revenue, other income. And I want you to please take note of that and make sure you understand each of these line items. Okay. Another thing that I want you to see here is if you look at the dividends. In this question, there was only dividends of the parent. Make sure you understand what to do, because that's the thing that's not one of the normal transactions, is the dividends. Okay, and students normally struggles with this. So make sure you know what to do when there was a dividend paid by the subsidiary as well. And I'll speak a little bit later when we get to the solution of this one, I'll speak a little bit about it as well. One other thing that I want you to see here, if you look at the credits, look at 760,000 ordinary shares. So the share capital of the subsidiary Daphne Limited, 760,000 ordinary shares, but the rand value is 950,000 rand. Ladies and gentlemen, take a note of that. When you calculate the percentage share or the interest that a parents or non-controlling interest hold in a company, you need to compare apples with apples. In other words, compare share with shares. Okay? So don't, if we give you the amount of shares that the parent bought, and go and divide that by the rand value of shares. So shares divided by shares. The next line item, retained earnings, can you see is 1 January 2015. In other words, that is the beginning of the period. Ladies and gentlemen, there are cases where we give you information in an exam or in a question that sometimes you just need to take note of it, but maybe it will be of no use to you. Okay? But things like this, dates, you need to put emphasis on the dates and draw yourself timelines. Okay? The year end of this company, if you look at the top, is on 31st December 2015. This retained earnings, the second line or the third line, the retained earnings line in the credits is 1 January 2015. In other words, what we try and tell you here is this was the retained earnings balance for these two entities, Fred and Daphne, at the beginning of the period. At the beginning of the financial year. Okay, let's go to the next slide. Additional information. I'm going to skip this first. I'm going to go to the required. Prepare the financial statements of the Fred Limited Group for the 31st December 2015 year. So here, what can we say? Can we see 31st December 2015 is the year end. We need the statement of profit or loss and other comprehensive income, the statement of changes in equity, and the statement of financial position. And that's quite a lot. So can you see in this question or example, we gave you the trial balances and not the skeletons or layouts or formats of these three financial statements. And that's why you need to know what is in these three different statements. Okay? And except for if you know what it is, don't go and write everything down that you know and that you've seen in the past. Make sure the items that you write down is actually covered in this question. If you look at these items here, make sure these items will be in your financial statements. So just have a quick scan through it and see, okay, this is the items that I need to go and write down. For example, in my statement of financial position, I will have property, plant and equipment because this entity or entities or group of entities do have property, plant and equipment. Okay. So now we know what our goal is, as I said at the beginning. We need those three financial statements at the end of December 2015, and we know there was trial balances given to us. Okay? So we read it and we see what can we see from it. On 1 June 2013, already if you stop there, I can see that if there's a gain on bargain purchase as an example in this question, that's going to be in the past. So there will not be in my current year statement of profit or loss and other comprehensive income, there will not be a line item gain on bargain purchase because it's not in the current year. And for a statement of profit or loss and other comprehensive income, you just look at or report transactions that occurred during the financial year. In this case, it will be 1 January 2015 to 31st December 2015. Can you see it falls outside this financial year? Okay. The statement of financial position is something different. That's going to be the balances as at 31st December 2015. So for example, in this question, if there was goodwill, goodwill is a balance. So it doesn't matter if this happened in the past, the balance will be in. If it's a gain on bargain purchase, not in P&L, but part of retained earnings. Don't know yet what in this question will be. Let's look. Fred Limited acquired control. Stop. I can immediately see there's a company, Fred, and a subsidiary because there's control, acquiring 570,000 of the issued ordinary shares. Ladies and gentlemen, we said earlier, we look at the number of shares to calculate the percentage. So 570,000 shares divided by the 760,000 shares given in the TB, in the trial balance, gives you 75%. In other words, Fred owns 75% of Daphne. So what is your non-controlling interest? Your non-controlling interest portion is 25%. Can you see students can make a mistake? They sometimes take the 570,000 shares and go and divide it by the share capital rand value. They're not comparing apples with apples. Okay. Let's read further. The consideration was settled in cash amounting to 810,000 rand. So this 810,000 that was paid is the investment in Daphne that you'll see in the trial balance. So on this date, the retained earnings of that Daphne amounted to 125,000. So can you see in the trial balance, the retained earnings was given to us at the beginning of the current year, 2015. This was the retained earnings at acquisition date, 125,000. So I'm just reading this so that you can see how I stop at every little piece of information given to see, okay, how I'm going to use this information. Where is it relevant? Where does it fit in? Let's look at the second portion. On 1 June 2013, there were no unidentified assets, liabilities, or contingent liabilities, and the fair value of all assets and liabilities were considered to be equal, blah, blah, blah. So if I look at this, I can see, okay, everything was at fair value. I do not have to make any further fair value adjustment. So why did I stop here and why did I read this sentence that's actually not going to be worth anything in this question? Is you need to look in the exam or in a question if there was anything that was not at fair value, because then you first need to go back and do the fair value adjustment. The Fred Limited Group measured its investments in equity instruments at cost. For this now, nothing. The Fred Limited measures non-controlling interest at its proportionate share of the acquiree's identifiable net assets at acquisition date. Remember I said to you earlier, there's two options here. Either at fair value or at its proportionate share of the acquiree's identifiable net assets. That's the two options, okay? When we give you this option and we gave, for example, fair value amounts of this in the question, then it's just to, let's say, confuse you a little bit. Then you leave that fair value amount. There is enough examples of that in the study material, and I think the one illustrative example that we'll do later in this session will cover it as well. Okay, so for now you need to know, okay, it's at the proportionate share. So that means we're not going to care if I give you a market value of the shares. We're not going to take that into account. That's the first thing. And the second thing is the non-controlling interest parties will not share in goodwill if there was any goodwill. So it's only at the fair value method where they share in the non-controlling interest. Ladies and gentlemen, I'm just going to quickly stop here. I know there's a questions and answer section as well where you can ask questions and answers. At this stage, I'm just looking at this slide at the moment, so I do not have those questions and answers open. If there is any questions later on, we will maybe take a 2-minute break and then I will go through it. If I do not get time to go through the questions and answers in this session, you are more than welcome at the end of the session to send your information or your questions to the course email address and we will respond to them from there. Right, let's continue with this. The SA normal tax rate 28% and capital gains at the inclusion rate of 80%. Okay, normally we will give you the tax rates. You don't have to know it out of your head. Each share carries 1 vote and the share capital remained unchanged. That's again just information that you're not really going to use. Both companies have a 31st December year end. Okay, now we've read through all this information. We know what we need to do. This is what's required. Now we're going to put the skeletons or layout or format, whatever you want to call it. We're going to draw that up. So look at this. This is the statement of of profit or loss and other comprehensive income. I want to stop here quickly. I'm just going to say 3 things quickly on these statements. Okay, what I want to say here is the following. If you look at the top, the heading, that's just an example. Fred Limited Group, consolidated statement of profit or loss and other comprehensive income for the year ended 31st December 2015. Ladies and gentlemen, sometimes, most of the times, we give marks for these headings as well. You need to know who are you reporting for, in this case, Fred Limited Group, and then what is the statement here? It's the consolidated statement of profit or loss, blah, 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 blah. And then the year end. So those 3 things, the names, what statement it is, and the year or the period you need to put in your heading. So I'm just going to go quickly to the other 2. Statement of consolidated changes in equity for the year. So who, Fred, what statement, consolidated statements, and there's the year, and then it's the same for the statement of financial position. Another thing that I want to show you here is the following. The first part, normally the students get this right, the revenue, cost of sales, gross profit, other income, other expenses, income tax, and all of that. What they miss is the other comprehensive income. Okay, if I remember correctly now, maybe not in this example, but in the example that I'll do at the end of this session, in this one, there's no other comprehensive income. So actually you don't need that one here, but put it in and at least know it for if there was other comprehensive income items in the statement. Then lastly, on this slide, I want you to look at the split that we will do at the bottom. Profit attributable to the owners of the parent and non-controlling interest, and total comprehensive income attributable to the owners of the parent and the non-controlling interest. This again is because we're gonna add the line items 100% of the parent and 100% of the subsidiary. This profit and this total comprehensive income at the bottom, we will show, okay, which part actually belongs to the parent or the owners of the parent and which part belong to the non-controlling interest. And that split is very important. A mistake that students normally make is they will take the profit of the company and then they know, okay, this profit that we've calculated here in the consolidated statement, multiply by my NCI percentage. In this example, we said 25%. That is non-controlling interest. Ladies and gentlemen, that's incorrect. It's a total wrong principle. And you lose very easy marks and you lose a lot of marks if you do it that way. So the non-controlling interest is a calculation on its own where you need to understand the principle and you need to focus. You need to go and use the subsidiaries information and calculate the non-controlling interest on the subsidiaries information, not on what you will get here, the 100% of the 2 entities that you've added line by line. Okay, that's enough. Let's go to the next slide. Look at the next slide. See all these black amounts that was given. You add them together, nothing difficult. So if you can just see this, and if you listen to what I'm saying as an example, you've got your heading, you've got your layout, and I'm saying to you, we're not giving marks for all these items, revenue, cost of sales, for the description every time, because sometimes we give you financial statements and then it's just copy and paste. Then we can't give you marks for that. But the heading, the date, the statement, and then here at the bottom, for example, profit attributable to owners of the parent, non-controlling interest, that's normally not in the information given. And then we'll say, okay, but now we can give the students marks for this because this is something that they understand. They understand there's going to be a split of the profit and the total comprehensive income that we're going to put here. Okay. Take note as well, there's not other line items included here. For example, stationery expenditure or whatever the case may be. This, ladies and gentlemen, is the layout of the statement of profit or loss and other comprehensive income. This is what you can see here. Don't go and add any other funny line items except for if there was other comprehensive income for the year and there was line items there, yes, then you can add them. But on top, you need to show revenue, you need to show cost of sales. Don't only show us the gross profit, because you need to show all these information separately to get the marks. Okay, so if you look at all the blacks that were added together, the black amounts, then you look at the first red line item that you can see. And on the income tax, you see only one amount. And why was that? Not because we don't add the income tax of the subsidiary. So let's quickly go back. Because there was, let's see. Income tax expense, Fred 612,000, Daphne 0. So that means for whatever the reason may be, there was no tax for the subsidiary, and that's why we only added the parent. There's another thing. So if we give you the income tax for the subsidiary as well, you will just add that as well. There's also one place where students make a mistake. They go and they calculate until the profit, and then they multiply by 28%. Ladies and gentlemen, that's not always the case. There's sometimes other items or deferred tax transactions in between. So you can't just use this profit amount. In this case, the 1965526, you can't just use that and multiply it by 28%. It's the wrong principle. So use the amounts given to you, and then all the additional information items that is affecting tax, you go and add or deduct those transactions that affected. You go and adjust this income tax amounts given to you. So that's another thing where students do make a mistake and they lose really easy marks. Let's go to the next slide. Let's see what was added here. So in this case, it is the consolidated statement of profit or loss, the Daphne Limited part. Okay, so remember, if you go back, I said to you, the non-controlling interest is going to be, the NCI is going to be a detailed calculation. So we're going to do that in the next calculation. We're not going to say this profit, the 1.3 million, multiply by 25%. No, because this includes the parent's portion as well. So we go to the subsidiaries portion and we calculate the profit for the subsidiary. I'm not going to go into detail. You can go and do this. All these amounts were given in the trial balance. If you quickly want to scroll back to your trial balance, you can do so. Let me do it for you quickly. So there's the trial balances, remember? So on the right-hand side, let's just look at one example. On Daphne, the second amount from the bottom is revenue 995,000 Rand. Okay, so there you will see revenue 995,000 Rand. So you will put everything given from the subsidiary in here. That's the first step, the easy part. Then you look at all the additional information. If there was anything that will affect one of these line items, you take that into account as well. And then you've got your total final profit for the year, and you go and calculate the NCI. Okay, so we know now, we said earlier the NCI percentage, 25%. So you take your profit, you multiply it by 25%, and there's your NCI, 55,628 Rand. Let's go to the next slide. There you see the red ones. Because in this question, if you look at the other comprehensive income for the year was 0, your profit and total comprehensive income for the year was exactly the same. Can you see at the bottom? That's why these two, let's call them recons or analyses, is exactly the same. Okay, because your profit's the same, your total comprehensive income for the year is the same. So these two splits will be the same. So the 55,628 is the NCI that was just calculated, and then the balancing figure is the amount owing to the parent. Please, also, don't go and take this profit and multiply it by 75%. Is the incorrect principle. You're going to lose, you're not going to get any more. So it's easy. Your profit, less your NCI amount that you've calculated separately, gives you the portion to the parent. Look at the slide for 5 seconds. One other important thing that I want you to see is I wrote here, the second red line item that I've written, reference as an example C1. So what students do, they've put an amount in here, and their amount is, for example, 125,000. So I can see it's not correct, it should be 55. And then they haven't referenced it. So they don't know how they've calculated and where they've calculated. So please reference in the exam. Something like this, if we go back one step, you'll see it's quite a long calculation. It will not fit in next to the non-controlling item, interest item. So you'll reference, so you'll write, for example, C1 for calculation 1, or you can call it A or B. And then at the top of this one, you will write A or C1, whatever the case may be. Then I know, okay, I can see this is calculated somewhere. I know exactly where to go and find it. So this is really important to reference during the exam. Okay, let's go to the next one. The next thing that was required was the consolidated statement of changes in equity for the year. Again, you write your skeleton. Share capital, retained earnings, non-controlling interest. Now this, you need to take carefully note. This is not the same as the statement of financial position and the statement of profit or loss and other comprehensive income, where you need to go and add 100% of the line items. That's the first thing. The second thing, you need to understand that in most cases you will have to know this layout or skeleton or format out of your head. So study it, it's not a lot to remember. Okay, let's go to the next slide. The next slide, we put in the two red amounts, which is the profit for the year and the non-controlling interest that you got directly from the statement that you've just calculated or that you've just prepared. So can you see here the profit to the parent, the 1,408,504 Rand, in other words, the balancing figure, and the 55,000 is exactly what you put in here. What's the mistake students do? Two things. First, the profit, they will go and put the full profit in here. In other words, the 1.3 million. Okay, and that's incorrect. You need to put in the portion to the parent. First thing. Second thing, the non-controlling interest that they put in here, for whatever reason, it does not agree to their financial statements. So they will have, for example, here in the P&L, they will have 55,000 Rand, and then suddenly here they will have 102,000. So please take note, in this profit for the year line, those two amounts needs to be exactly the same as in the one that you've just calculated. Easy marks. If you've got this, you've got your heading correct, already received a few marks here. Let's look at the next one. As I said, this one, share capital, you add 1.5 million, only those of the parent. Make a note of it. Students don't do it. They add the subsidiary share capital here as well. If you can remember when we did the first two examples in the balance sheet or in the statement of financial position, the share capital portion, yes, we've added at the beginning, and then with the first pro forma journal, we actually eliminated the subsidiary portion. So for share capital, it will only be the amount of the parent, 1.5 million in this example. The same with the dividend. And remember I said earlier, in this example, there's only dividends for the parent, so that's easy. So let's deal with that first. So in this question, dividend, can you see it's at the retained earnings column? In other words, this company paid out dividends to its shareholders, and that's why it's a negative. That's why you put it in brackets, because it's decreasing your retained earnings, because you pay the dividends from that retained earnings. Again, the same as with the share capital, make a note. Only the dividend paid of the parent entity will be reflected in the retained earnings column. If there was dividends paid by the subsidiary, the only place where you would have taken that into account is in the non-controlling interest column. Then you will take the subsidiary's column, dividend paid, multiplied by the percentage owned by the non-controlling interest, but it's not affecting the retained earnings column. Take note of that. Students make mistakes of this in the exam, and that's the easiest marks you can get. Okay, so far, nothing difficult. If you know the basics, you've already scored a lot of marks. Right, now a little bit difficult, not difficult, more calculations, is you need to go and do the retained earnings calculation, opening balance, and the non-controlling interest opening balance. We're first going to do the retained earnings calculation. Can you see again, I've referenced it, C2. So what is this opening balance? It's the retained earnings balance of the parent given in the TB, 417,000. If you look at calculation C2 at the bottom, we first skip the sub, Daphne Limited, and we go to Fred. And I tell you, it's 100% of the parent plus the movement in retained earnings of the subsidiary multiplied. And this is now the first time that this is just a little bit differently, not 100%, but 75%. In other words, the percentage the parent owns in this subsidiary. Okay, so what is it? The retained earnings opening balance, to say it in another way, is the opening balance of the parent and the subsidiary's movement. Okay, so you take the parent's one that was given, and if it was not given to you, but information was given for you to calculate it, yes, then you need to calculate it. As an example, if we give you or gave you, instead of the retained earnings balance at 1 January 2015, and we gave it at 31st December 2015, then you know it's the closing balance. Then you need to work backwards towards your opening balance. In this time, we gave it to you, so you take 100% of the parent's opening balance, and then you say the movement of the sub. And why the movement? Because this the revenue or retained earnings up until the date that we bought shares or Fred bought shares in Daphne, those retained earnings does not belong to the group. That was before the group was involved in this. And that's why we only take the movement. Okay, so there's your movement multiplied by 75%, which is the number of shares owned by the parent in this subsidiary. Okay, and there it is. Nothing difficult, but students struggle with this. This opening retained earnings balance and the opening non-controlling interest balance, students struggle with it because they don't understand the basic principles. Let's go to the non-controlling interest. Okay, so there again, I've referenced it, and there you see it again. So what do we have here? So we calculate the non-controlling interest at, okay, at acquisition, right? And that's the total net asset value at that point, which is the share capital plus the retained earnings, gives you 1,075,000 Rand. Multiply by 25%. Why do we use 25% here? We're looking at the non-controlling interest portion here. Okay, so the NCI at acquisition, 268,750. Okay, then we say, okay, but now that was at acquisition, what the non-controlling interest is worth at that moment. But there was movement since then. and then we go and calculate the movement in the retained earnings, which is the retained earnings balance at 1 January 2015. Why do we use 1 January 2015? Remember, because we're looking at the opening balance, the balance at 1 January 2015 line item of non-controlling interest. Okay? And we say, okay, but at that point, what is my NCI worth? So it's obviously the NCI at acquisition that we've just calculated, the 268,750, plus the movement that took place between that at date, the acquisition date, and the beginning of the current year. Okay, because we're looking for the opening balance here. Okay, the retained earnings at the beginning of the year is 367,751 Rand, less the retained earnings at acquisition that was given earlier in the question. So that's the difference, that's the movement, the 242,751 Rand, and then you multiply it by 25%. And the NCI at acquisition plus the sins portion, in other words, the movement, give me my non-controlling interest balance at the beginning of the year. Ladies and gentlemen, these two amounts normally, when we ask the consolidated statement of changes in equity, is normally the ones that's counting a lot of marks. And you can see that. Sometimes you may be lucky, we give it, but then we maybe, for example, don't ask the statement of P&L, and then the profit is not a transfer from a statement, but then you'll have to go and calculate that, for example. Further, take special note, sometimes we will give you the profit as well, so that you don't have to either go and calculate it, or there's already enough marks in the question, and we only have 3 hours to test you in the exam, and that's why some of the information is given to you in the examination. Then you need to use what was given. If you don't know the basics, you will not know what to use, where to use what was given to you. Okay. And now that's the closing balances. So important. I've already said that. You can go and read this in your own time. I just want to see if there's something that I've missed here. Oh, take note of point number 5. So these important points, I've covered all of them. Take note of other items not in this example. For example, the subsidiary paid a dividend and so on. So just go and look at examples. Once you know this basics, go and look at examples where there's something different. And if you know the basics, you don't have to go through all of this again. Then you just go through the basics. Happy? Next one, the consolidated statement of financial position, skeleton. Can you see the only item that I've added here, non-controlling interest, the red one? Okay. So this is the only difference, if I remember now correctly, that was not in example 1 and example 2. If there was goodwill, in this question, obviously, on the non-current assets, you will have to add the goodwill line item as well. Okay, immediately insert the amounts that are carried over from the consolidated statement of changes in equity. Ladies and gentlemen, this again is, as I said in the previous slides as well, you've already done it now. They can't be different to this. Look at the 1.5 million and look at the 1.5 million total year. Look at retained earnings, 1,880,372. Exactly the same. Look at the non-controlling interest, exactly the same. If yours is not the same, then we know in the exam, okay, this student does not understand the basic principles. So you need to know, as I said earlier, these amounts, those two amounts, comes directly from the statement of P&L. If we see you haven't done that, then we know you don't understand the basics. If we see these totals, the balances in the statement of changes in equity do not agree to what you've put here in your statement of financial position, we can immediately say, okay, you don't know the basic principles. Let's look at the new one, or the next one. Again, the black amounts, that's the amounts given in the question. And you can, it's obviously difficult maybe now for you, you don't have the slides in front of you, or print it out. It's not easy to just go back because I've got control over them. So at the end, what you can do is maybe listen to this again, and then you work through these examples and you see, okay, but wow, where do they get this property, plant and equipment amount? You'll see it's coming directly from your trial balances that was given to you. Okay, what's the only different thing here? Goodwill. Okay, you can go and calculate this goodwill now on your own time, but there's nothing difficult here. It's the cost less the equity multiplied by the shareholding percentage. That's the one thing that you need to know. So the equity, so we've paid, Fred Limited paid 810,000 for the percentage share. And what is it that they bought? They bought the 950,000 share capital plus the 125,000 Rand retained earnings, but they only bought 75% of that. Okay? And they've paid 810,000, which is more. And if you pay more for something, it means, okay, I've paid more. That means somewhere there's an asset sitting there that I don't know of yet. And that asset is goodwill. And that's why we add it as an asset. If it was less, it means, okay, well, I don't trust this company. Don't believe that's it. So I want to pay a little bit less. If you pay less for something, you buy a bargain. Happy. One other thing that I want you to remember here, if you see goodwill, you need to test goodwill annually for impairment. Luckily on third year level, we will give you that amount. So we will either say to you, goodwill will be impaired or was impaired with the following amount. Then you just deduct that amount. Or we will say goodwill was impaired to an amount. Then you know that's the new goodwill figure. And the difference is the part that you write down. Okay, but we will see in the next example, in the illustrative example, we will have an example of goodwill and goodwill impairment. Ladies and gentlemen, I think we've covered the basics now. We've went through a few examples and I showed you the easy marks that you need to get. So what now? We're going to go through one company with one example with a few intercompany transactions after I've explained a few things. And then I want you to obviously at the end of this discussion, well, maybe not today, need to think of what I said, make a few notes, and then please apply these things that I gave you, the ideas in your studies. So I'm going to take a 10-second break. So there's going to be silence of 10 seconds to 30 seconds, and then I'll be back. Okay, so we're going to look at intercompany or intragroup transactions. What are they? It's when there are two companies or a group of companies and there's transactions between these companies. Okay, things that we need to look out, for example, is inventory. So normally the one company will buy something from the other company, which is inventory. And then you need to take note that there could be, if company A sells inventory to company B or B to A, there can be profit in there. And if that inventory was not sold to a third party, to company C, then it means that profit has not yet realized for a group. So just take that into account. The same with property, plant and equipment. Company A can sell a vehicle to company B, there could be profit. And then for both of these items, there could be tax effects. And then there could be bank items that could be between the two groups, or something that you need to look out for. Not just what's on the slide, a few other things as well. There could be loans between two companies. Company A grants a loan to company B or other way around. There could be Company A could perform work for Company B, for example, then there's management fee. Or Company A can deliver something for Company B, then there's delivery fees and revenue on the other side. So look at these things and just think for yourself, okay, this was now the transaction between these two companies, but now we are a group. So for a group, what is the end result for the group as a whole? Okay, let's look at these examples quickly. Okay, I see we're running out of time here. There's around 40 minutes left, and I want to go through these examples and quickly through one illustrative example. So I hope you've got maybe 10 minutes extra to listen to me today on this nice Sunday afternoon. So let's go. I'm going to go a bit faster through these. Betty Limited is a subsidiary of Alpha Limited. Okay, so we know here A and B. A is the parent. A Limited, I'm just going to make it short. A Limited sold inventory to B Limited at a profit of 25% on the cost of inventory during 2018 and 2019. So here we can see there's 2 years involved here. On 31st December 2018, Betty Limited had inventory on hand of 300,000, which was bought from A Limited. Sales for the year to Betty Limited for 2018 amounted to 850, and for 2019, 920,000 rand. On 31st December, Betty had inventory on hand of 200,000, which was bought from Alpha Limited. Assume a tax rate of 28%. So in this example, if you look there at the bottom, at the top, the green, the parent sell to the inventory, sell inventory to the sub. Okay, you can get it other way around as well. So in this examples, I'm only going to show you when the parent sells to the sub. You need to go and look in your own time what is the case when the subsidiary sells to the parent. Okay, then you need to know, obviously, when the subsidiary sells to the parent, okay, those information will be in my analysis if I do an analysis of equity for a calculation, or that information I need to take into account when the sub sells if I calculate non-controlling interest. That's just an example. Okay, so the journals for 2018. Remember, when we do the statement of profit or loss and other comprehensive income, we have all those lines, then we add 100% of each line item. So in 2018, if A Limited sold inventory to the value of 850,000 rand, can you see that that revenue, that 850,000, was included in the line item? So if we would do a consolidation, and let's say that was the only transaction, then the revenue for the company would be 850,000 rand. But that's not true. It's true in A Limited's book, but in the company A Limited Group or Alpha Limited Group, it's not true, because Alpha Limited as a group did not sell this revenue to an external party. And that's why we will do the following journal. We will say debit revenue or sales and credit cost of sales. Why? Because the revenue line item in A Limited's book there was too much revenue for group purposes, and the cost of sales was also too high, so we need to reduce that, we credit it. So that's with the total sales amount. Then we look at cost of sales. So cost of sales and inventory, the 300,000 rand in the inventory at hand. Okay, remember, because the rest was sold by B Limited. So that 300,000 rand that's sitting there at year end for the group, there's no profit yet made on this, and that's why we need to do the following adjustment. So we'll say 300,000 multiplied by 25 divided by 125 to get the unrealized profit. So this 60,000 is the unrealized profit in 2018. So we debit cost of sales. So if we debit cost of sales, the expenditure increases, and if the expenditure increases, our profit will reduce. I hope it makes sense. So there's unrealized profit in the company's book, A Limited, but for the group, there was no profit on this 300,000 because it was not yet sold to external parties. So we need to take the unrealized profit out. Same, this inventory is sitting as a debit in the books of B Limited. They bought it, still sitting there. But there's a portion profit in there. That's not really a cost to the company. And that's why we go and take that out. We credit inventory with the same amount. And then the next two journals is this just the tax effect on the 60,000. There was less profit, so there will be less tax. So 60,000 multiplied by the 28%, which is the tax rate. I hope you understand this. This is really important. In each question, there will be intercompany transactions, and most probably one or two of the intercompany transactions will be inventory. One other thing that I want to show you here, two things that you need to see, or one thing that you see here, two things that I want you to remember. On this one, we said there was a profit in the second line, sorry, from the top, a profit of 25% on the cost of the inventory. Then I'm not going to be able to explain now too much in detail. All I want you to know is then you say the inventory, which is 300,000 in this case, multiplied by 25 divided by 125. Okay, so in other words, then you add the 25 there at the back. So 25 divided by 125. If we had said the profit was 25% on the selling price, it will be 25 divided by 100. I just want you to take note of that. See how we give it differently in different questions so that you don't make that mistake, because this is easy marks. To get the unrealized profit, we give you the inventory amount, you calculate it based on the percentage we give you, easy marks. And can you see, even if you've got the 60,000 wrong and you've multiplied it by 28% to take the tax effect into account, that is your principle. And for that principle, we would have given you your full marks, even if your amount was wrong. Okay. The same journal that I've just showed you was in 2018. So if you need to do that journal in 2019, because we're sitting now in 2019, if you look at the heading, journal entries for 2019, you will have retained earnings and cost of sales with the 60,000. And then income tax and deferred tax, 16,800. So what happens now? Obviously, because of the past, there was an effect on your retained earnings. You bring that effect into account in the current year, in the next financial year. And then hopefully that inventory will be sold to external parties during the current year. And that is why you will pay more tax in the current year, and that is why your cost of sales will decrease in the current year, because it's inventory that you brought forward. Okay, the opening inventory, the closing inventory of 2018 is the opening inventory of 2018, and that inventory will be sold during the current year. That's why that profit portion, you affect the cost of sales in the current year, and obviously as well the income tax. And why retained earnings? Because the retained earnings balance that you would have in your consolidated statements in the prior year will not agree to your individual statements because of this journal that you've done in 2018, and that's why it's affecting retained earnings. Can you see deferred tax as well? The deferred tax was a debit in 2018. Now, because the tax is going to be increasing, the deferred tax will be cancelled out. The journal in 2019 is based on the 2019 info, and it's exactly as the journal that we've done here, just with the 2019 information. Okay. The next one is when the parent sell a non-depreciable asset to the subsidiary. So Johnny has 100% interest in Walker. Johnny controls Walker. On 2 January 2019, Johnny Limited sold an office building to Walker for 20,000 Rand. The carrying amount of the building was 15,000 Rand. Okay, prepare the journal entries for 2019. So can you see, for the group, there was no profit. in the books of Johnny Limited, there was a profit of 5,000 Rand, yes. But for the group, no profit because this building was not sold to external parties. So now it's the same as with the inventory. There's sitting a profit in one of these entities' individual books, but for a group, it should not be there. So we should go and take it out. Okay, so what will we do? So we can see this is easy. The information was straightforward. If Johnny sold it for 20,000 and the carrying amount was 15, there's a profit of 5, but that's not true for the group, so we need to reverse that. So we will say other income or profit on sale of buildings, 5,000 Rand. So we debit it. Remember, this was now credit in the books of Johnny Limited. So we debit it, and then we'll say credit property, plant and equipment with 5,000 Rand. Why? In Johnny's book now, in Walker's book, he bought this office building for 20,000 Rand. So in his individual books, the asset is sitting there at 20,000 Rand, but it's too much. For us as a group, that's not true. For us as a group, it should be 15,000, and that's why we credit property, plant and equipment. In other words, we reduce it. Okay. So the first one, the profit on sale of buildings, the 5,000 Rand, is the same as inventory. Profit will affect your tax. So obviously, if we reduce the profit now, we debit other income, we reduce it, we should reduce our tax. And that's why we say deferred tax debit, 5,000 multiplied by the 28%, which is the tax rate, and you credit income tax. I'm going to repeat something. Your income decreased to 5,000 Rand. So obviously you're going to pay less tax. And that's why your income tax expense, remember an expense is normally a debit, is credited. You're reducing it. And then you recognize the deferred tax asset on this one. That means for the group, that 1,400 Rand should not have been taxed. So it's an asset for you. You're deferring it until you're gonna sell this to external parties. Then this is gonna realize. Just one thing, remember earlier in one of the slides, I'm not going to scroll back, you can go and do it in your own time. When I showed you the layout or the skeleton of the statement of profit or loss and other comprehensive income, there was a line item other income. So in normal situation, you would have add the parent and the subsidiaries other income amounts together. And now because this is a debit, you'll go and say minus 5,000 next to the other income line item. In the next year, this was now in 2019, in the next year, your effect will be on retained earnings. Remember, because the statement of profit or loss and other comprehensive income items, I told you, it's for a specific year. Once that year is gone, it rollovers to the statement of financial position. And that's why you will debit retained earnings with 3,600 Rand. Okay. What is the 3,600? It's the 5,000 of other income less the 1,400 income tax expense. Those are the two items that would have been in your statement of P&L. And that's why it's affecting retained earnings. You will then debit deferred tax, credit property, plant and equipment. Why do we do this credit of property, plant and equipment again? Can't remember if I said that at the beginning. Remember, consolidation journals you don't do in the individual books of the companies. Consolidation journals you do for consolidation purposes, for financial statement purposes. In other words, you will have to do this journal every year. Okay. Parents sell a depreciable asset to a subsidiary. It's the same, exactly the same as in the previous example. Okay, same information given. So look at the journal for 2019. The only difference that comes in when it's a depreciable asset is this unrealized profit, the 5,000 that we take out, will realize over time. And that time is over the useful life of this asset. Okay, so it's through depreciation that unrealized profit will realize. So students, when they see, oh, it's a non-depreciable asset versus a depreciable asset, they start to get scared and they get frightened, you shouldn't be. It's exactly the same, it's just the depreciation. And then obviously depreciation is affecting my profit, then there's going to be a tax effect on that as well. So if you look at that, the only thing that I want to show you here is this asset was sold on 31st December 2019, if you look at the second sentence. And the journal entries is on 31st December 2019, on year end. That's why on this first journal, there is no depreciation effect, because there was no time that passed where there was a portion of this income that has realized. So now let's look 1 year later than the previous year, journal entries for 2020. Again, the retained earnings, deferred tax, property, plant and equipment, exactly the same as in the previous example, okay? And in the previous slide. Now what will we have? This other income is going to realize through depreciation. And that's why you will say credit depreciation and debit accumulated depreciation. Okay? So why depreciation normally is a expense, and it's a non-cash expense, and expense is a debit. So why do we credit this? Because this asset is sitting now in the subsidiaries book, and it is higher than what it should be. So now we decrease that depreciation to get it in line for what it should be for the group. So the income realized through depreciation. And because your depreciation was credited, income tax expense is debited and deferred tax is credited. So even if your amount was incorrect here, your depreciation calculation, and you know the principle that it is affecting income tax, you should get the right answer if you use your depreciation amount multiplied by 28%. So depreciation was decreased. That means there's lower expenditure for the group. When there's lower expenditure for the group, there's more profit. When there's more profit, there's going to be more tax. That's why you debit income tax and you credit deferred tax. Okay, so that is just a depreciable asset. And if you look at the information given here, just want to see quickly, depreciation, if you look at the fourth line, depreciation is provided for at 20% per annum on the straight line method. That means 20% per annum means is just another word for over 5 years, because 5 20s give you 100%. So that's why at the formula at the bottom you can see we use 5 years or 20% is going to give you the same answer. While I'm on that, I forgot to say that earlier. Can you see in this one there was enough space to put next to my accumulated depreciation, or as an example my retained earnings line item, there was enough space to put the calculation in brackets. There's no right or wrong. In the exam, in your disclosure, you can either put it if there's enough space next to your line items. For example, you will have a line item property, plant and equipment, and you put your calc in brackets. And for the big ones like the non-controlling interest, you will have C1, C2 or ABC, or you can all of them reference it to calculations. That's your choice. For me, I think you'll save some time if you do the easy ones next to the line items in the questions. Okay. So, no need to be scared if you know the basics and the basic principles. Okay. And if you've exercised this throughout the year. So, ladies and gentlemen, we've got 20 minutes left. I do apologize if I'm going to steal 5 or 10 minutes of your Sunday and go a little bit over the time, but let's see. I quickly want to go through a few things that I want to discuss, and then just a few things in an illustrative example. Okay. In the exams, you can go and actually read this in your own time. Let me just do this. Okay. let me just say a few things here. No marks will be allocated if an answer is wrong and there is no cross-reference to the calculation. I want you to listen carefully. I've said it a few times, and that's the truth. So reference properly so that we as markers can see where you get your amounts. If it was a perfect world and your answer was 100% correct, then obviously there was no such need or such urgency for you to reference properly, because if you're right, you're right. But most of the times there's errors, and that's why we need you to do that. Know your subject basic principles and disclosure. We've discussed that. It's important to prepare for the exam under exam conditions. I've said that, and that's why I want to stop here again. It's really important. You need to do questions. That's how you test yourself, and that's how you know if you can do these answers under exam conditions without looking at your study material. So do questions as if you're sitting in an exam, and then importantly, as I said previously, mark yourself and learn from your mistakes. That's where you need to make the mistakes. No issue. Just find out, ask yourself, why do I differ and why did I make this mistake? And if you can't figure it out yourself, then you contact us. To read what is required in the exam is really important, because sometimes students ask what was not required, answer what was not required, and you waste valuable time with that. And I think I've said the last time, 0.5 a few times. You can again go and read this in your own time. How to approach a question. I'm going to read quickly through this, but I want you to go through this in your own time as well. You read the required. And why? Because you need to know what is it that we ask you, and you need to know what is the date or the financial period we're looking at. Then you read the question and you identify the group structure. In other words, you need to see, okay, there's a parent and a sub. If later on now there's associates and joint ventures, you need to see that as well. And then you need to identify intergroup transactions and to mark which entities are affected. Then you read the required again to make sure you haven't missed it or missed anything, because the required is short. It's not going to waste a lot of your time. You make sure when the financial year end is and other important dates. For example, when shares in another entity is purchased, when inventory was sold, is it only opening inventory or closing inventory that's going to be affected, when the asset was sold, because you need to know from when do I need to do this depreciation. Remember in the previous example, the asset was sold exactly on year end. That's why in the first year, there was no effect on depreciation. But in the next year, there was. So look at the dates. Prepare your answer book by starting with the layout or skeleton, whatever you want to call it. Leave sufficient space for if there is items, for example, goodwill that you've missed out. Then you fill in the given amounts in the skeleton. You read the information again to do your calculations or adjustments or analysis. And then you complete your skeleton. And reference, please, that's important. Ladies and gentlemen, this is just a guideline. You need to take this and work around this and get something that's going to work for you. So you need to get a method, and you need to test your method by doing questions. Okay. Illustrative example. Scooby Limited is a company that produces dog food. Scooby invested in a dog food distributing company called Scrappy. Both the entities had a 31st December year end. Okay, so some of the information that you get in a question will tell you nothing, and some will tell you something. Okay, you need to, through exercise, make sure you get in a position where you can do that easily, where you can identify, okay, what do I need and what not, and what are they trying to tell? So here you can see there's a group, because Scooby invested in Scrappy. And there you can see both entities had a 31st December year end. So that's what I want you to do when you read something, to think about it that way. Then the following are extracts from the trial balances of Scooby and Scrappy for the year ended 31st December 2015. Again, we only gave you the trial balances, and you can see the year end here. It looks like it's going to be 31st December 2015. Okay, so what did we say in the previous slide? You first need to go to the required. So I'm just going to jump to the required. And there's the required. Okay, in the exam, you will not get something highlighted in blue. So the blue is, for me, I've highlighted it so that you can see the difference, so that you can see something important. Prepare the consolidated statement of profit or loss and other comprehensive income of the Scooby Limited Group for the year ended 31st December 2015. So now we know, that's easy. We know the year end, we know what they want. B, prepare only the asset section of the consolidated statement of financial position of Scooby Limited Group as at 31st December. This is where I got confused at the beginning. I mixed up my two questions. In this one, we only ask the asset section. So if you're going to prepare your skeleton, like I advised you earlier, and you write the assets and the liabilities and the equity, you're wasting time and you're not going to get marks for it. So some students either misread it and don't only do what we require, or they think, okay, but if I'm going to show them this, I'm going to get extra marks here because they know I know everything. That's not the case. Answer what we ask you. Next, prepare only the retained earnings and NCI columns of the statement of changes in equity. So remember at the beginning there was also a share capital column, and there could be other columns as well. In this one, we only ask retained earnings and NCI. Okay, now let's look at the information. Again here, I only highlighted the trial balance and 31st December so that you know you need to look and see, okay, this is what they gave us, and this is the year end or the financial period, or at least the date of the trial balances. What if they gave me the trial balances of 2014? Okay, so this is the trial balance at least at year end for the statements that we need to do or prepare. Okay, I'm just going to open this one quickly. And all I want you to see here is we just talked about, let's just go back, Scooby Limited bought the investment in Scrappy Limited. And now I see here, if I look at the investment in Goofy Limited, investment in Droopy Limited. So far there was nothing here. So I think this will just be simple investments. And if it's simple investments, they are just straightforward. Okay, so don't stress about too much about them. Let's just go a little bit down and we see, okay, well, there's an accumulated loss. We haven't covered that because this is the funny thing students see, and then they think, oh no, I can't do this. Nothing difficult here. Accumulated loss, you will see when we treat it. Nothing difficult. Nothing difficult. Income tax expense, again on this side, only for the parents, 612. Most probably because they sit with an accumulated loss, there was no tax, and that's it. Dividends paid, 31st December 2015, again only for the parent. Remember what I said? If there was for the subsidiary as well, you only take the NCI portion into account in the statement of changes in equity. Luckily, in this question, there wasn't any. Okay, let's see at the credits. There's a market-to-market reserve that looks funny now, new thing that wasn't covered earlier. Again, that's just a equity account. So Mr. Jacques van Staren, I think, will be, when he covers one of the other learning units, I don't think it's the next session, I think it's the 5th session, he will talk about that. Deferred tax, I want to, because I know the question now, I want to take note that this deferred tax in this question is a liability because it's a credit. Just remember that. Then you will see here long-term loan Scooby, 330,000. Okay, so this is Scooby in Scrappy. So if there's a long-term loan in the one's books, it should be in the other one. So just think about it. And then bank overdraft, Courage Bank, just think about that as well. That's also funny. We'll talk a little bit about it. And then at the bottom, there's suddenly other comprehensive income. And this was given to you. So just remember in your statement of P&L, there's going to be a line item, fair value, other comprehensive income, which is the fair value adjustment on equity investments. Okay. So let's go to the additional information. We do not have the time to read through each item now. What I actually wanted to do is that you look at all 10 these items and you identify or ask yourself, okay, what will I do with number 1? What will I do with number 2, etc. And except for what will I do with it, what will it affect? The statement of financial position or the statement of profit or loss, or both of them. Okay, so after this discussion or this session, I want you to either tonight or as early as possible in the week, go through the slides again. It will be published on Myonisa, and then you go through these items and ask yourself, okay, why was this given to me? I'm going to jump the gun now. I'm going to tell you, and we do the following. We've identified that Scooby Limited is the parent, and on this one, 570,000 shares divided by 760, it's 75%. Okay, I've explained to you how we calculate this, and I explained to you shares divided by shares because you want to compare apples by apples. Don't look at the rand value. All right, my skeleton of my income statement or my statement of profit or loss and other comprehensive income. Can you see exactly as we did earlier? Nothing new. But look at the red item. Fair value adjustment on equity, net of tax. This, luckily, was given here in the trial balances. We'll see in the additional information if there's something that's going to affect it. Well, I can tell you in advance, in this example, there wasn't any. So you're just going to add those two amounts together. But that should ring a bell to you that you know that this profit attributable to and the total comprehensive income attributable to, there's going to be two different things here, because in this example, my profit and my total comprehensive income will differ. You'll see it now. Okay, there's all the easy amounts, the easy marks, everything given to you, added together. So all these red ones that I've highlighted red is the ones that you can see from the trial balances. Okay. So we give you marks for those, maybe not always full marks or whatever the case may be, but you'll get something for it. So put it in your skeleton. Now, affecting transactions. Okay, I'm not going to go through this as well. I'm going to go through the detail of each one. Go and read through this in your own time. And I've highlighted some of the things in color that fits together. Okay, for example, if you just look at this, the first one, point number 3, Scooby Limited started selling inventory. This is just that you can see, but Scooby is selling. And then the green, okay, but they mark a profit, markup of 40% on the selling price. Okay, so just go and look in your own time to these things. We've covered a lot of these things. The only thing that I want you to show is point number 8. Okay, and if you look at this points here, for example, number 8, this was just the additional information given that I've went through, and I took out everything that's going to have an effect on the statement of profit or loss and other comprehensive income. And that's points 3, 4, 5, 8, which has a direct impact, and then just two general things, points 6 and 9. Okay, so I just want you to look at point 8, and it says on 31st December, the goodwill was tested for impairment. Now, if it just stops there, except for if we try to confuse you with something, already if I look at this, I can see in this question, there's not going to be a gain on bargain purchase, because they're telling me here that the goodwill was tested for impairment, and it was determined by the directors that the goodwill was impaired with 2,750 Rand. Okay, so that's why I stop at this point. You need to see, okay, you need to know there's going to be goodwill. So already in your statement of financial position, remember the required section is assets. There's going to be a asset section, non-current asset goodwill. All right. So, and here you can see it's impaired with 2,750. That means whatever your balance is that you're going to calculate, you're going to deduct 2,750 Rand of it. If we say goodwill was impaired to 2,750, that 2,750 will then be the balance in your statement of financial position. That is then your balance. So take note when we say impaired with or impaired to an amount. And that's just another example how we can play with words, say something a little bit different, and then it means something different. something we can say something different and then it can mean something the same. So we can play with words. That's what I'm trying to say. So read carefully and just stay calm and do what you need to do. Okay, so let's go. During the current year, Scooby started selling inventory to Scrappy at a profit market of 40%, and this is exactly the same as what we've did when I explained the unrealized profit of intercompany inventory sales earlier. So this is just the same. This is just transaction number 3 of the additional information given. The only difference here, we said here 40% on the selling price, the profit markup. So remember what I said to you, then you're going to say 40% divided by 100 when you do the calculation. There's your journals, and look at the bottom. NB, only if the subsidiary sells PPE or inventory, then the intercompany transaction impact on the analysis or the NCI. Okay? So look at these journals. This is because of this intercompany inventory that was sold, and the intercompany inventory resulted in an unrealized profit of 48,000 Rand. Now you go to your skeleton and you say, okay, I need to adjust revenue. I deducted 350,000 Rand because for a group, the revenue is overstated. The same with the cost of sales. But there you can see the 48,000 at the cost of sales as well. And that is the unrealized profit. And that unrealized profit will have an effect on the income tax. And that's why you will deduct the 13,440, because there was now included in this income tax, the 612,000 Rand, there was profit and tax based on inventory that was sold by the company, by the parent, which is not a profit for the group. And that's why we reduce the income tax. And so you will go for the 4th one as well. That was just profit on the sale of a the delivery vehicle. It was the same as in the examples I've done earlier. So again, there's profit and depreciation. If depending the depreciation on when the asset was sold. So you can read this in your own time. I want you to show you the effect on the financial statements. There's your journals. Take out the profit and the property, plant and equipment, deferred tax and income tax. Okay? And because of the timing when this asset was sold, a portion of this profit will be through depreciation, and that's why you will take your depreciation into account. And look at the 6 over 12 months, because this happened exactly halfway throughout the financial year. That's where you get the 6 over 12. Let's look at the statement of profit or loss. Other income will be reduced with the 25,000 profit. Other expenses will be reduced with the 3,125. What is that? That is your depreciation. Okay? So there's no separate line item here, depreciation. You will slot it in at the other expenses line item. Then the same with the income tax. With the income tax, because your other income reduced, your profit reduced, your income tax reduced with the 7,000 Rand. If you look at the journal, and that's why you deduct the 7,000 Rand here, and you add back the 875 Rand that has realized now through depreciation. And there it is. Okay, let's go to the next one. Transaction 5. Transaction 5, we haven't covered something like this. At the end of the current year, Scrappy urgently needed stationery and the supplier could not supply. Therefore, Scrappy purchased stationery amounting to 50,000 from Scooby. The sales from stationery accounting records were included in other income and the purchases in other expenses. So on this one, maybe the information is a bit vague here. There was no profit that could be realized to third parties. So all we're going to do is we're going to reverse that transaction to make the individual line items of the financial statements correct for the group. Okay, so the net effect on tax here will be 0 because your income decreases, your expenses decreases for the group, so there's no effect on tax. The last one, goodwill was tested for impairment and impaired with 2,750 Rand. Then we know if it was with 2,750 Rand, we know what the effect will be. The goodwill impairment that will be in your statement of profit or loss and other comprehensive income will be 2,750 Rand. Okay? Which is under your line item, other expenses, 2,750. If we said it was goodwill was reduced to an amount, you need to calculate the goodwill at acquisition, and then you need to calculate the difference between at acquisition and this amount given, so that you can see what the impairment loss should be. Okay, let's add them all together. Can you see the profit for the year is 1,299,816 Rand, and the total comprehensive income 1.3 million something. I'm not going to give the exact amounts now, you can read it. So they are different, and that's why the two splits that you do at the bottom will be different. What did I say earlier? I said the non-controlling interest, you can't take this profit and just add multiply it by the percentage. You will have to go and calculate the NCI. Ladies and gentlemen, is there just someone who can just tell me, because obviously we ran over the time here, I just want to make sure if you can hear me on the question and answer, if someone can just indicate to me if you still hear me. So I'm just gonna pause here for 30 seconds. I just want to see if someone can inform me if they can hear me. No, I can't see anything. I see now the questions and answers. There was a few students who asked me to repeat things as well. Hopefully you can still hear me on that side. I'm just going to continue, and if there was anything unclear that you would like me to explain earlier, you're more than welcome to phone me tomorrow or phone any of the other lecturers, or you can listen to the slides, because the slides will be available at the end so that you can go through them and listen to them again. It will be as with class 1, it will be on my UNISA. If you and you will see a link there that you can follow under facet classes, where you can open this recording and listen to the whole presentation again. So I'm going to continue. I've showed you that there's a difference. Now we need to calculate the NCI. So you'll take the loss of the year from Scrappy, all these amounts, the 995,000 and so forth, was given in the trial balance. So that's just the revenue and the other income and the cost of sales and so on. So you will go and calculate your loss for the subsidiary, multiplied by the NCI percentage, which is 25%, and then you get your profit of 55,528 Rand. Okay, now we just put that into your skeleton, and then the balance between the 1.2 and the negative 55, because it was a loss, gives you the owner's portion of 1,355,444 Rand. Okay, if we go to the comprehensive income, it's the 8,000 Rand from Scrappy that was given in the trial balance. If you could remember at the beginning, I showed you there's only 2 items there. That's the 8,000 multiplied by the NCI percentage, which is 2,000. But this is a positive, okay? Because this was not a loss. Remember, the 55,000 was a loss. So you will deduct these two from each other. So the total comprehensive income attributable to NCI will be 53,000. I've put that in at the bottom, the red one. And again, because it's a negative because of that accumulated loss, you will add it to the 1.312053 to give you the owner's portion, which is 1,365,581 Rand. Okay, now the asset section. Ladies and gentlemen, I do apologize. 10 more minutes and I'll be done. So there's your skeleton for the assets. Can you see the goodwill line item that was added? Because we said in this one we can see there was goodwill. And then the only other thing that I want you to see here is Scrappy Limited has a bank overdraft. You cannot net off the bank overdraft against the cash and cash equivalents. Why not? Because there's certain rules that you need to adhere to before you can do that. So please go in your own time, look at the rules, make sure you understand the rules. And I think if I remember correctly, this was a discussion question in the previous exam, and you need to know those rules. So because they did not adhere to the rules here, it was not taken into account at cash and cash equivalents. Okay, again, the same as with the statement of profit or loss and other comprehensive income, you will go and take transactions to see which transactions are affecting my statement of financial positions, and there they are. Okay, some of them was also in the statement of profit or loss and other comprehensive income. So I've highlighted it out here for you. The one thing that I want you to see here is the group measures non-controlling interest in its proportional share of the acquiree's identifiable net asset at acquisition date. And I think I've discussed this at the beginning as well. So just take note of that. Let's look at the first transaction. This was given. Oh, yes, I need to go back. I've discussed this at the beginning when I said to you at the proportional share. Okay, sometimes it can be at fair value. If you look at transaction 1, we gave you the information, the last sentence, at the acquisition date, the market value of Scrappy Limited share was R1.42. You will not use it because this is not done on the fair value as per point 7 on the slide. Okay? Calculate goodwill or gain on bargain purchase. I said to you earlier, and this one was not actually easy. It's easy to know it will be goodwill, and as it worked out, this one, the goodwill at year end was 2,750. Remember, we said earlier, one of the questions, it needs to be, the goodwill needs to be in a test for impairment annually. If you look at number 8, and it was impaired with 2,750 Rand, it's just by accident that in this question, or by accident, maybe the person who prepared the question, who did that it works out on the same amount. Normally, say for example, your goodwill here would have been 10,000 Rand, and then if we said the goodwill was written down with 2,750 Rand, you will just say 10,000 less the 2,750 to get your amount in the statement of P&L. Okay, that's just to give you more clarity here. So there's your goodwill amount. We go to the next transactions. We've done most of these now. Okay, most of these journals affected the statement of P&L. So for example here, what will affect us here? If you look at the second journal, inventory will affect my assets. And then the other thing, deferred tax. But remember I said to you earlier when we checked and we watched the trial balance, the deferred tax given in this questions was liabilities. And because this is an asset, you will not have a deferred tax asset and a deferred tax liability in your financial statements. You will purely go and put this debit at your deferred tax liabilities in your financial statements because it's less. If you go and look at your trial balance, you'll see this 13,000 is less than the deferred tax credit or liability that was given in the trial balance. So the only thing that will affect in your statement of financial position, the portion that was required is inventory, and there we take the inventory into account. And then the same with this transaction, two items that will affect it. There you go. Property, plant and equipment, as well as accumulated depreciation. Remember, accumulated depreciation is not shown separately on the statement of financial position because you combine it with your cost. So the carrying amount is shown. So same principle of the deferred tax asset as just explained. There's your property, plant and equipment. You deduct the 25,000 and you add back because of the accumulated depreciation. Transaction 8, which was your goodwill impairment. So in this case now, the goodwill was impaired with 2,750, which was exactly the same as our balance. So in this case, the net effect was 0. The net result was 0. And that's why I'm saying if your goodwill was, for example, 10,000, it was then 10,000 less this 2,750. So there's your asset section of the statement of financial position. The last part is the statement of changes in equity. Statement of changes in equity, again, I've explained to you earlier, this is just retained earnings and NCI columns that was required. You start with the easy ones, that was the profit and the non-controlling interest from your statement of profit or loss and other comprehensive income. You then bring in your dividend paid, only the parent, in this case there was only by the parent, and then you go and calculate retained earnings and NCI and you reference it, and you can go and do that in your own time. So I'm just going to go slowly through the slides to see if there's something I want to point out, but it's exactly the same as the examples I gave you. There's going to be one thing at the retained earnings that I just want to show you. So there's my calculation, and if you look at the second line from the bottom, you will see long-term loan written off reversed, 330,000. That was just one of the transactions, and here's the transaction. In the additional information given on 31st December 2013, due to poor financial position of Scrappy, Scooby Limited wrote off the loan made to Scrappy against retained earnings in its own separate accounting records. Remember when we checked the trial balance, we saw the loan there, but only in one of the two entities' books. Why was that? Because we can see now Scooby Limited, the parent wrote off this loan. But because for consolidation, we need to reverse those loans. We need to reverse this amount that was written off as well. So important, it was a prior year transaction. In the trial balances, the loan is still in the books of Scrappy, but not in Scooby. So we first need to reverse because it's going to be a problem if we want to do this consolidation journal that you can see here. So if you go to the next slide, you'll see in the accounting records of Scooby, what we've done there, we said loss on loan written off because that was a loss to them. So it decreased their profit at that time, and credit loan to Scooby because this loan was a debit in the books of Scooby. So now we credit it, we take it out. That was in the past. Now we say, no, but we can't. We need to reverse that for consolidation purposes so that both loans reflect so that we can reverse both loans. Otherwise, there's nothing else to reverse, only this one loan that's sitting there. Okay, so what are we going to do? We're going to put that loss, the P&L amount, the debit that you can see here, against retained earnings because, again, it's not in the current year, it comes from the prior year. So you'll say debit loan to Scrappy to bring it back in the books of Scooby, credit retained earnings. Now it's back, and now the next one, you can go and eliminate the intercompany loans. So that's the only different thing that was not covered in the earlier section. So in your own time, you can go and see the retained earnings calculation. You can go and see the NCI calculation, exactly the same as discussed earlier. And there you go. And there's your closing balances. Last thing, analysis of owner's equity. You will see that in a lot of questions. Just take note that the analysis of owner's equity is just calculations or methods to show you how to get to amounts. Go and read through this in your own time. All I want you to take note of is if we require financial statements and you just do the analysis. You have not answered what we've asked. Okay, so if you want to use it as a method to get to your amounts disclosed, by all means, just remember it's actually just a calculation. Make sure you know amounts in your analysis, why do you calculate them, and where are they used in financial statements, and if you use it, reference properly. Exam technique, ladies and gentlemen, you can go and read through this exam preparation and exam tips that I've given here in your own time. I hope you've learned something today. You can read this also in your own time. This is just what I wanted you. It's to be able to learn throughout this discussion. It's just the assessment criteria of this learning unit, and I hope it helped you. I hope you have a wonderful day further. Good luck with your studies, and please remember to study hard, study throughout the semester, and contact us as lecturers if you need any assistance. Goodbye.